and welcome to the 5th episode of HSBC Wealth Masterclass, a special series that takes you through all the aspects of various investment products available for investment in India. Now, in this show, we're focusing on domestic debt as an asset class, and to help you understand this class better, we've brought on board the show two experts. We've got Rajiv Anand, who's Chief Executive Officer of Axis Asset Management, joining us on the show to begin with. Rajiv, firstly, thanks very much for coming in on the show. Now, typically the majority of investors in India tend to invest in debt products, be it fixed deposits or post office savings. Equities as a product is something that they've clearly stayed away from. About 4 to 5% at best of household investments go into equities. Now, debt as an investment class, why do you believe it is that the average investor is attracted so much to debt and they haven't moved away from debt as yet?
I think there are two reasons there. I think the Indian is traditionally been a risk-averse investor. And so therefore, if you see what my father or my grandfather did with their money, it was typically into a bank fixed deposit, and even within that, it was typically into a state bank kind of bank fixed deposit, a public sector bank fixed deposit. And I think what used to add spice, so to speak, to their portfolio is what used to be called administered saving instruments, PPF and NSCs and such like. And I think some of these products used to have a little bit of tax advantage, etc., and so on and so forth. So therefore, the core of the portfolio, I think, comprised fixed income. And I think the other very, very important aspect was predictability of returns. I think Indians even today are not able to comprehend the volatility of markets and what it does to portfolios. And so therefore, I think even today you find that about 55-56% of household savings goes into bank fixed deposits.
Shada, since on this episode we are making a case for debt as an asset class, why would you say it is that investors should consider debt as an investment?
If you look at equity as an asset class, over a 10-year period, volatility of the markets are in the vicinity of about 25% on a year-on-year basis, which means that the markets, your returns could fluctuate plus minus 25 of a mean, which is quite a lot. So what that means is that equity clearly is an asset class for the long term. And I think there is enough evidence to suggest that if you want to beat inflation over a long period of time, you have to have some part of your money in equities. However, if you want to generate income on your savings, there are various fixed income instruments that you can invest in, including various types of mutual funds, and there are also mutual fund products which put together some component of fixed income and a little bit of equities, such that the volatility of the markets that we just spoke about is mitigated to a very large degree. So therefore, for the investor, if he wants to beat inflation over a long period of time, I think it probably makes sense to put some money away in equities, because just investing in fixed income may not necessarily help you in the long term.
So now, when you typically go and do your wealth planning with a bank, the common formula that most banks use is that the younger you are, the more the money you should be putting in equities is, and the older you are, the closer you're getting into retirement, the more the money you should be putting into debt is. Do you believe that's an acceptable formula, or would you suggest that maybe investors ought to look at it differently, and that maybe even from the time you start working, allocating more money into debt as investments may also be a safe idea?
I think you've hit on a very interesting point here. I think what is very critical for investors to understand is two things. One, the time horizon to investment, meaning that if you want your money back in the next 1 year or 2 years, it probably makes sense for you to buy into fixed income products. But if you've got a long-term horizon, 3 years and beyond, I think almost always you'll be better off buying into equity, because clearly the kind of returns that you can get out of equities over a long period of time are much, much superior. And remember, in the Indian context, notwithstanding the fact that some of the tax rules could change in the near future, all your long-term gains from equities are tax-free in your hands. So therefore, when you look at it at a post-tax level, from a long-term perspective, equity investing certainly makes sense.
All right, but typically the traditional products that everyone tends to look at is fixed deposits. Today you have a number of people looking at debt mutual funds as another investment class. But how about post office savings, national savings certificates, some of the bonds issued by corporates to raise money? How would you view those as asset classes?
Within the fixed income component, like you rightly said, there are various options available. From the mutual fund perspective, what we've done is we've created products based on your time horizon of investing. So therefore, if you got overnight money, you can invest in liquid funds. If you got money for anything between 3 months to 1 year, you can invest in short-term funds. And from a long-term perspective, you can invest in bond funds. There are also other options available, like you said, post office and such like. The good thing here is that post office savings are, for all practical purposes, government guaranteed. So you're not carrying credit risk on your portfolio. But if you're buying into a corporate debt, so a bond issued by an NBFC or bond issued by a corporation, you are carrying, over a long period of time, you're carrying credit risk on your portfolio. What that means is that the probability that you'll get your principal back at the end of 3 or 5 years is not certain. So let's say, for example, a NBFC or a corporate goes bust during the period that you hold the bond, you will not get your principal back. And that's the risk that you're running when you buy into a single name or a single issuer in your portfolio.
We are now joined on the show by Shantanu Ambedkar, who's Managing Director for Institutional Sales at HSBC Global Markets.
Hi.
Right, Shantanu, welcome to the show. Now, we were just, before we took a break, we were talking about the fact that if a customer walks into a bank and asks for various investment products available to him to invest into, typically you are offered products like equity mutual funds. There's no mention ever made of the debt products available on offer. You've got to ask for it before it's actually, made available to you.
Well, I don't think that is entirely true. What we have is a process by which we do the risk profiling of every investor who walks into the branch or who the RM speaks with. And that risk profiling will throw up what sort of risk appetite that investor has. And this personal risk profiling, if it is more towards the conservative side, the proportion of debt investments, whether those be in the form of deposits or those be in the form of debt mutual funds, will certainly have a higher weightage than what equity has. But I think what has to be recognized is that very often investors do walk in with very little equity, and therefore perhaps the first suggestion which might come in is to include some amount of equity into the portfolio. But given that a lot of investors have a fairly conservative profile, the entire gamut of debt investments should be offered to that investor.
Shraddha, we've spoken about a number of debt instruments available to the investor. We've spoken about mutual funds. We've spoken about fixed deposits. One product that I'd like to touch upon is the fixed deposits, debentures offered by various companies. Now, one very unfortunate thing with investors is that typically all of them just look at the coupon rate on offer and blindly go into those investments. I remember in '97 you had this huge crisis of NBFCs defaulting in a big manner on deposits that they'd raised, offering 17%, 18% rates of interest. What would you say an investor needs to typically look at before he puts money into these investments? I'll start with you, Rajiv.
If you look at a corporate bond, I think most investors have protection because typically these bonds are issued by companies which are listed on the equity stock exchanges. These bonds are typically rated and rated fairly highly. I mean, in most cases that I have seen, they're either AAA or AA+, which means that they are of very high safety from a credit perspective. You don't get the same sort of safety in a company fixed deposit. You have no protection. You are what is called a unsecured creditor. So if the company goes bust, you are effectively the last in line, to get your money back. So I would urge investors to be very, very wary of investing in company fixed deposits, or as you rightly said, be attracted by the high coupons that some of these company fixed deposits offer you. Obviously, there are very, very reputed names that also offer company fixed deposits. Go ahead and buy into those. But obviously, in those cases, the coupons may not necessarily be very high. But I think it is very important for investors to understand that you are carrying a very high degree of credit risk on your investment when you buy into company fixed deposits.
Sure. So the coupon is not something that you need to be entirely guided by. Shantanu, apart from that, what would you look at as far as the company goes in terms of the business it does, the quality of management? What would the aspects you would look at be before you invested in the fixed deposit of that company, without looking at the coupon?
If your objective is capital preservation and with some return which is reasonable, then you ought to be risk minimizing your debt investments. So therefore, we would obviously look at the rating for the companies. And you would only look at very highly rated companies who you would want to put your money with, because the extra bit of return in coupon terms that a lower rated company would provide you may not necessarily compensate you for the extra extent of risk that you are taking as far as your principal is concerned. And like I said, if your idea is not to do a risky investment, then there is no point in being enticed by that couple of percentage points of extra coupon that will give you that you will get out of investing in a more risky instrument.
So now, when it comes to investing in the equity markets, everyone tells you that timing is paramount to maximizing your returns. Would you say the same applies to investing into debt products? Would you say that if I had to invest into an equity mutual fund, entering at the top of the rate cycle may be the best idea?
On the fixed income book, look at it differently. By not investing, every day you're actually losing out on accrual. Right? So therefore, it makes more sense for you to stay invested rather than not stay invested. So yes, interest rates will go up and down, fiscal deficits will go up and down, the rupee will depreciate and appreciate. I think most of us experts really have no clue on that on a day-to-day basis. So for a retail investor to try and make that decision is quite difficult. So arrive at an asset allocation which banks like HSBC will do for you, and stick to that. You have a certain percentage into fixed income, certain percentage into equities, and keep rebalancing, relooking at that based on your risk profile, based on how your portfolio has performed over the last quarter or last 1 year, and I think you'll be pretty good.
But how about when it comes to investing in maybe fixed deposits? Would you say then that investing on top of the rate cycle makes sense because you lock into a high rate, where you stay locked in for maybe 3 years, while a month or two later you may start seeing the rates start getting cut?
There is perhaps some way in which you can do that, but I think there are, again, whether you are going to be in a fixed deposit at that point of time, or whether you want to lock your money into a fixed maturity plan, these are things that you can definitely do and try to do it at that point of time. But I would also say that if you did so in a mutual fund which provides you capital appreciation as a result of reduction in rates, and this is just to go back to the basics, when rates go down, the price of a bond goes up. So if there is a mutual fund which is holding bonds at the current rates of interest, and the rates are expected to go down, the value of that fund goes up, implying your NAV will go up. You could get a little bit of a upside by going into, say, a bond fund or a short-term bond fund with limited increase in your risk, but potentially a slightly higher increase in your return as compared to simply putting it into a fixed deposit.
All right. Now, all of this, of course, brings us to the million-dollar question, where returns on debt investments in a country like India are far lower than inflation. So why consider debt at all as an asset class? I'll start with you, Shant.
I think the way to look at it is that, yes, in the long run, equities have outperformed debt, and that's a given. I would put it in two ways. One is, does every investor have the ability to ride out the volatility that you see in the equity markets and the cycles that you go through with it? If the answer is no, then there is no choice but to be in debt to an extent. And there the answer also is that a debt at all points of time will at least provide you some return and not a negative return. The other thing is that in terms of even long-term studies sometimes show, and these are disputable at some point of time or they're specific to markets, but there have been studies which show, depending upon the time frames that you take, that debt returns could even be close to equity returns in certain time frames.
Sure, but Rajiv, Shantanu made the point about capital preservation, but at some level there is actually capital erosion, because if inflation's running at 10 and the return on your investment is 8, your real return is actually -2. So there is, in some sense, your investment that's getting eaten away without your realizing it.
The investment time horizon is very critical. So if you got money for a very short period, the probability that you will make money in the equity markets is 50-50, right? I mean, but as you keep going longer, the probability that you will get a positive return is higher and higher. So in the interim period, so let's say anything between 1 day to 3 years, it probably makes sense for you to have some component of your savings in fixed income products, which gives you that predictable returns over the short to medium term with very, very low volatility, and you can add the icing to your portfolio, icing to your returns, by having an equity component which will sort of deliver for you over a longer period of time.
All right, Rajiv and Shantanu, we'll take a very quick break on the show, but when we come back, we've got some viewer queries that we will try and address.